Special Reports is a daily show that will cover issues surrounding the economic collapse. All our reports and daily alert news are backed up by source links. We work very hard to bring you the facts, and we research everything before presenting the report. Subscribe for latest on financial crisis, oil price, global economic collapse, dollar collapse, gold, silver, Bitcoin, global reset, new world order, economic collapse, economic news, political, geopolitical news. Today, we talk about, get ready for the 100-year flood. One of the long-standing reasons to own physical gold or invest in gold mining shares is to hedge geopolitical risk or the risk of natural disaster. From the Black Death in the 14th century to the 30 Years' War in the 17th century to the World Wars of the 20th century, gold has been a reliable store of wealth. There is no reason to believe that such existential events are no longer a danger. Below is a copy of Albrecht Dürer's woodcut titled The Four Horsemen of the Apocalypse, 1498. That title is a reference to the New Testament book of Revelation 6, 1-8. Conventionally, the horsemen are called conquest, war, famine and death, but those names are subject to scholarly debate. The famine passage refers literally to high prices for food, which could also be taken as a reference to financial ruin through inflation. I don't think you need any reminder of the litany of risks present today. The United States is determined to prevent Iran from obtaining nuclear weapons. Iran is equally determined to develop them. Iran's neighbors, such as Saudi Arabia, have said that if Iran obtains nuclear weapons, they will quickly do the same. In that case, Turkey and Egypt would follow suit. The choices boil down to a conventional war with Iran or a wider nuclear arms race in a highly volatile region. North Korea already has an arsenal of nuclear warheads with a yield approximately the size of the Hiroshima atomic bomb, about 15 kilotons of TNT, but it has tested much larger weapons. It has also developed intermediate-range ballistic missiles (IRBs) and has tested intercontinental ballistic missiles (ICBMs). Denuclearization discussions are ongoing between the U.S. and North Korea, but President Trump has made it clear that he will attack North Korea if it advances further toward its stated goal of having a deliverable nuclear weapon that can reach the U.S. If talks fail and the U.S. does attack North Korea, it is likely that North Korea will unleash devastating force on South Korea and possibly launch a nuclear weapon aimed at Japan. Venezuela is a political and humanitarian catastrophe and is approaching the level of a failed state, which could result in civil war, riots, mass refugees and a cut-off of its oil exports, about 3% of the world total today. Its inflation rate is now running at over 40,000%. That means its hyperinflation has officially exceeded Weimar Germany's, where the highest recorded monthly inflation rate was only 29,500%. The IMF now forecasts Venezuela's hyperinflation will reach 1,000,000% by the end of the year. Other hotspots around the world include Syria, Ukraine, Israel and its confrontation with Hamas and Hezbollah, the Saudi war with Iranian-backed Houthi rebels in Yemen, and conflicting claims in the South China Sea. That's just scratching the surface. Natural disasters abound, from the extreme flooding of Hurricane Harvey to the lava flows of Kilauea on Hawaii. The Ebola virus has re-emerged in the Congo, 4 years after a prior epidemic in West Africa caused 10,000 deaths. Other threats are ubiquitous. New threats are also emerging that are not traditionally geopolitical or natural. These include power grid collapses, cyber warfare, hacking, data theft and misuse of big data, including examples such as Russian interference in recent U.S. elections. Killer robots, swarm attack drones and rogue artificial intelligence applications are coming soon. An investor would not be blamed for saying, "So what?" Many of the threats mentioned have been festering for years. Going back further in time would produce a different list of threats, most of which never came to fruition. Americans, in particular, seem safe from the worst of these threats except for the temporary effects of a bad storm or wildfire in a specific area. To most Americans, these threats are just background noise. Complacency rules the day. But here's an interesting bit of math, somewhat simplified, that might break investors out of their complacency. Don't worry about the details, but I strongly urge you to focus the implications. Let's consider a 100-year flood, which can literally be a 100-year flood like Hurricane Harvey, or a metaphorical rare event, a so-called black swan. Let's call P the probability of a 100-year flood in a known flood zone and consider the odds of the flood happening or not happening each year in a succession of years. We can express this as P 100 minus year flood equals P F equals 1% equals 0.01. P no 100 minus year flood equals P F single quote equals 1-0.01 equals 0.99. P no flood for 2 years equals P F single quote times P F single quote equals P F single quote 2 equals 0.992 equals 0.9801. P no flood for X years equals P F single quote X. Therefore, P no flood for 30 years equals P F single quote 30 equals 0.9930 equals 0.7397. No flood 74%. Flood 26%. This means that over a 30-year period, the probability of one 100-year flood is 26%, or more than 1 chance in 4. This math is called a Bernoulli process. Again, don't worry about the details. The point is that disastrous events with tiny probabilities of happening in a short time span are almost certain to happen over a longer horizon. Let's take the above math and consider 4 separate catastrophes, each equivalent to a 100-year flood, with no correlation to each other. If the odds of each individual event happening in 30 years are 26%, the odds of any one happening in the same period are 100%. As we come up with a longer list of 100-year floods, the time frame of one event happening with 100% certainty goes from 30 years, to 20 years, to 10 years, etc. In other words, the next 100-year storm is waiting for you right around the corner. By the way, real-world experience bears out this math. When we consider recent financial catastrophes affecting U.S. investors only, without regard to other types of disaster, we have had major stock market crashes or global liquidity crises in 1987, 1994, 1998, 2000 and 2008. That's 5 major drawdowns in 31 years, or an average of about once every 6 years. The last such event was 10 years ago. So the world is overdue for another crisis based on market history. Does any of this mean you should go to your fortified bunker and curl up in a ball? Of course not. We all wake up every morning and face the day, come what may. I'm not paralyzed by fear and neither should you be. But it does mean that we need to overcome any cognitive bias about the future being like the past, or about recent calm being a good forecast for the future, called recency bias by behavioral psychologists. When the 100-year flood is hit, it's too late to buy flood insurance. Likewise, when the next financial crisis hits, it will be too late to buy gold at today's relatively attractive prices. The best time to buy flood insurance is when the sun is shining. The Fed is on a collision course. Is the Trump economic boom a mirage? The data say yes, but the Fed models say no. The Fed has a long track record of sticking to its model-based approach and missing major turns in the U.S. economy. Current Fed policy will push the U.S. economy to the brink of recession later this year. When that happens, the Fed will have to reverse course and ease monetary policy. This will send the dollar crashing while gold and the euro soar. At first, the claim that the Trump economic boom is nothing special seems contrary to the happy talk headlines coming from CNBC, Fox Business, Bloomberg and other mainstream business media outlets. Those economic cheerleaders recite the stimulative effects of the Trump tax cuts and point to the Atlanta Fed's forecast that second quarter GDP will be 3.9% as of the July 11th update. The Atlanta Fed estimate of 3.9% is in line with forecasts from National Economic Council head Larry Kudlow, Art Laffer, proponent of the eponymous Laffer curve, Steve Moore and others that say Trump's programs will produce persistent trend growth of 3-4% or higher. Such growth would break decisively with the weak growth of the Obama years. It would also make the U.S. debt burden, currently at 105% of GDP, more sustainable if GDP were to grow faster than the national debt. There's one problem with the happy talk about 3-4% growth. We've seen this movie before. In 2009, almost every economic forecaster and commentator was talking about green shoots. In 2010, then Secretary of the Treasury Tim Geithner forecast the recovery summer. In 2017, The global monetary elites were praising the arrival, at last, of synchronized global growth. None of this wishful thinking panned out. The green shoots turned brown, the recovery summer never came, and the synchronized global growth was over almost as soon as it began. Chart 1 below illustrates the fact that any signs of trend growth are strictly temporary, basically moving growth from one quarter to another through inventory and accounting quirks, and are quickly followed by weaker growth. In the first quarter of 2015, growth was 3.2%, but by the fourth quarter that year growth had fallen to a near recession level of 0.5%. In the third quarter of 2016, growth was 2.8%. But it fell quickly to 1.2% by the first quarter of 2017. In the third quarter of 2017, growth was 3.2% but then returned to 2.0% by the first quarter of 2018, about the average for the past 9 years. This pattern of temporarily strong growth followed by weak growth has been characteristic of the entire recovery that began in June 2009 and entered its 10th year last month. In fact, we've seen even more extreme reversals in the recent past. In the third quarter of 2013, growth was 4.5%, even higher than the Atlanta Fed forecast for the most recent quarter. But by the first quarter of 2014, just 6 months later, growth was actually negative, minus 2.1%, comparable to some of the worst quarters in recent recessions. Growth was 5.0% in the third quarter of 2014, but then fell off a cliff and was barely positive, 0.2%, in the first quarter of 2015. You get the point. Strong quarters have been followed by much weaker quarters within 6 months on 6 separate occasions in the past 9 years. There's no reason to believe the second quarter of 2018 will be any different. The longer-term view of the entire recovery is more revealing. The recovery is currently 107 months old, the second longest since the end of the Second World War. The average recovery since 1980, a period of longer than average expansions, is 83 months. So this expansion has been extraordinarily long, 30% longer than average, indicating that a recession should be expected sooner rather than later. But the current expansion has also been the weakest recovery on record. Average annual growth during this expansion is 2.14%. Compared with average annual growth for all expansions since 1980 of 3.21%. That 3.21% figure is what economists mean by trend growth. The current expansion does not even come close to that trend. The wealth gap, the difference between 3.2% trend growth and 2.1% actual growth, is now over $4 trillion. That's how much poorer the U.S. economy is due to its inability to achieve sustainable trend growth. As for the Trump bump, growth in the first quarter of 2018 was 2.0%, slightly below the average since June 2009. Growth for all of 2017, Trump's first year in office, was 2.6%, slightly above the 2.14% average in this recovery, but not close to the 3.5% growth proclaimed by Trump's supporters. In short, growth under Trump looks a lot like growth under Obama, with no reason to expect it to change anytime soon. In fact, the headwinds caused by the strong dollar, the trade wars and out-of-control deficit spending may slow the economy and bring future growth down below the average of the Obama years. Into this mix of weak growth comes the Federal Reserve, which is tightening monetary policy, reducing the base money supply and supporting a strong dollar. All of these policies are associated with slower growth ahead, an inverted yield curve, and a high probability of recession. The Fed is explicitly on a path of raising interest rates by 0.25% every March, June, September and December like clockwork unless one of 3 pause factors appears: disorderly markets, weak job creation or disinflation. Since none of the pause factors are apparent now, the Fed should be expected to raise rates in September and December 2018 and beyond. Simultaneously, the Fed is reducing its balance sheet, destroying base money at an annual tempo that will reach $600 billion per year by end of 2018. This policy is completely unprecedented in the 105-year history of the Fed, so its economic effects are unknown. My estimate, and that of others, is that this balance sheet reduction policy is equivalent to 4 0.25% rate hikes per year on top of the 4 already planned. The combined effect is the same as the Fed raising rates 2% per year off a near-zero rate base as recently as December 2015. Bearing in mind that monetary policy works with a 12-18-month lag, this extraordinary tightening policy in a weak economy is almost certainly a recipe for a recession. Why is the Fed tightening if the economy is fundamentally weak and the probability of a recession is so high? There are two reasons. The first is that the Fed is using badly flawed models including the Phillips curve and a stochastic equilibrium macro model called FRB/US or FRBUS. These models do not correspond to reality, but the Fed follows them anyway, which is why the Fed has never accurately forecasted a recession in its history. The second reason is that the Fed knows a recession will happen sooner rather than later and is desperate to acquire some dry powder in the form of higher rates and a reduced balance sheet so it can deploy rate cuts and QE when the time comes. The problem, of course, is that by pursuing these policies, the Fed will cause the recession it is preparing to cure. The single most important factor in my analysis is that when the Fed realizes its mistake of tightening into economic weakness, it will have to turn on a dime and shift to an easing policy. Easing will come first through forward guidance and pauses in the rate hike tempo, then possibly actual rate cuts back to zero and finally reversing their balance sheet reductions by expanding the balance sheet through QE4 if needed. When that happens, the dollar will crash and alternative currencies such as gold, silver and the euro will soar. Jay Powell seems determined to continue rate hikes on an aggressive path and possibly to accelerate the hikes. But he might be in for a severe case of whiplash when he has to make a hard pivot to easing. But by then, the damage will have been done. Thanks for watching. Tell us what you think in the comments section below.